Joining us right now to break down that big week is Kamal Srikumar. He's the president and investment strategist at Srikumar Global Strategies. Also, Stephanie Link, chief investment strategist at Hightower and a CNBC contributor. And Sri, let's start with you, because I think a lot of us are still trying to figure out what the heck happened when it came to the 10-year yield last week. What's your best guess?
The best guess, Becky, is that the volatility came out of the fact, first, the big drop in the yield to 125 on Thursday, because there was a sudden worry that growth had peaked in the whole world. The COVID variant Delta was becoming very effective, they thought, and that the Fed would be ineffective in promoting growth, and that's what caused the big drop in yield. Then by Friday, much of the fear was gone. The expectation was that growth would be back, and so you have the surge back to 135. There are fallacies in both moves. The drop assumed that if growth were to slow, that means lower yield. I disagree completely. If you have a pickup in inflation at the same time that growth slows, the yield will rise. Similarly, on the way up, if you're now happy that growth has come back, at 136, you shouldn't be buying the 10-year yield because you're going to get a negative real yield and you're looking for something much higher. So in both cases, Becky, I still expect, as I've been saying on your program for quite some time, that we are headed toward the 2% mark. The volatility of last week doesn't change my view one bit.
How soon do you think we're headed towards 2% by the end of the year, Sri?
By the end of the year, it's very much like it. I said, I think on your program in March and April, we are looking for about 6 months away. I think roughly speaking, that is still the case. As you said earlier, watch for the consumer price, wholesale price numbers tomorrow, the next 2 days. And Chairman Powell will probably say Wednesday, Thursday, that inflation is still temporary. That might in turn put the yields down in the short term. But longer term, at some point within the next 3 or 4 months, you're going to see the reality of the pickup in inflation dominate over all of the calming statements from the chairman. That's when yields start to rise. And when they do go up, they may go up 20, 25 basis points in a couple of days.
Stephanie, that question of whether we're at peak growth, that's going to be front and center when we're listening to all of these earnings calls starting this week. If we're at peak growth, that may be the case. I think the bigger question is, does that mean we fall off a cliff afterwards? What do you think?
Good morning. I actually think that peak growth is definitely here, right? First and second quarter of this year. But I think the stimulus is still plentiful. And so I think you're going to continue to see above trend line growth. Maybe not the 8-9% growth that we'll see this year. But I think that we'll probably get to about 4 or 5% growth next year. That's still above trend. And as Sri mentioned, I think that we are seeing inflation. I don't think it's all transitory. And at the same time, you do have low interest rates. Even if rates go to 2%, that's still a Goldilocks recipe for risk on assets. And so for earnings, I think earnings are going to be quite good. 40% year-over-year growth kind of thing, maybe even better. The key is going to be margins and to see how companies are navigating through the supply chains and if they have pricing power. And if you have better demand and pricing power and margins can stay strong, you'll have operating leverage. And I think you're going to see more operating leverage in the economically sensitive companies, which is where I am kind of a little bit more overweight versus the secular growth technology companies.
Like which one of those companies or which sectors? What are you talking about?
So, I mean, look, I'm overweight the banks, I'm overweight the industrials and also in energy, but I'm not ignoring some of the technology companies as well. The secular growth is too compelling. But look, for the banks, even though they have pulled back in the last couple of weeks, they're still up 30-40% year over year, right? Or year to date, rather. So the expectations are high. I think you're going to have puts and takes. We know they have to lower net interest income because of loan growth and the flat yield curve. But again, if you think that the yield curve is going to steepen into the second half of the year and the economy continues to be strong, consumer growth will be actually very positive for these companies. So you have to be patient. And oh, by the way, after the companies report earnings, they're going to start to buy back stock. We already know many of them have raised their dividends. Dividend yields are going to be 2.8 to 3%. That's pretty attractive. And the stocks are still trading 1.5 times book.
Shepard Smith here. Thanks for watching CNBC on YouTube.